Hi, Nirothambi Pillay here, author of the book How to Build a Property Investment Portfolio That Pays You an Income Every Month and Investment Property Advisor. And in this video, I want to talk about how you can analyze and how you can work out which property markets are set to grow next. See, because over the last few years, it's been pretty easy to make money in property, right? You buy something in Sydney or Melbourne, almost anything, and it would rise in value. We've had some massive rises in price. We all know that. But since about the middle of 2017, things have changed. In fact, right now as I record this video, CoreLogic reports that the Sydney market has had over 12 months now of prices falling, and those price falls are set to continue. Melbourne has now joined in as well, and prices in Melbourne are starting to fall. So I recently put out a video where I said that just because the Sydney and Melbourne market are starting to fall in price doesn't mean that you've missed out on creating wealth through property, especially if you're looking to retire within the next 10 years or so. I offered two strategies, and one of them was to find markets that are now starting to grow in value. You can see Australia is a country of multiple markets. So just because Sydney and Melbourne were growing over the last few years didn't mean that all the markets around the country were growing. I mean, Perth, in fact, was actually falling and is sort of still continuing to in many parts of Perth. So now that Sydney and Melbourne are slowing down and many suburbs are starting to fall in value, in fact, domain.com.au reports that certain areas in Sydney have dropped $230,000. So the median price has dropped $230,000 in just the last 12 months. So it's a very, very different game right now in terms of investing in property, and if you want to create wealth through property, but it's still possible. And as I said in my earlier video, one of the major things I suggest, or one of the easiest strategies I suggest, is to find markets that are growing in value right now, identify those markets, find the right type of property that's affordable for you, and let the market do the work. And I got lots and lots of feedback from that video. Many people actually private messaged me and wrote in and said, how do you find markets that are going to grow in value? Right? Especially when your local markets, if you live in Sydney and Melbourne right now, those markets essentially aren't growing, and I don't expect a lot of growth to appear over the next few years either. So the question is then, how do you identify markets outside of where you live that are growing in value? And you see, this is the exact situation I found myself in when I started investing back in 2002. At the time, the Sydney market was poised sort of where it is right now. We just had massive growth run because of the Sydney Olympic Games. But back then, prices were getting to a level where people couldn't afford them right now. Some suburbs are starting to fall in value, and many of the research experts were predicting that prices wouldn't crash, but they would go flat. They would fall slightly and then go flat for many, many years. And that's exactly what happened, because from 2003 until 2012, the Sydney market, the median prices in Sydney barely rose. It was essentially 9 long years of next to no growth. So when I could see the writing on the wall, when I could see that was happening, my thinking was, if I want to invest, why would I invest in a market that was either going to fall, depending which suburb I picked, or was going to go flat for so many years? Sure, it's good. It came right in the end. And look, even right now, the Sydney and Melbourne markets, they will rise again in the future. But I don't want to buy something that's not going to rise in value for potentially 9 years. Right? So that's where I was when I first started. So I was like, well, what do I do? How do I do my research? So I spent forever looking online, reading every single book I possibly could, attending the various seminars, doing everything I possibly could to educate myself. And I finally decided to take the plunge, and I bought an investment property all the way over in Western Australia. And I'm not suggesting you do the same thing right now, but that's what I did. And at the time, almost everyone I knew thought I was bonkers. They thought I'd lost the plot. Yet 18 months later, those same people were completely stunned to see that I doubled my money in just 18 months. To be honest with you, I was kind of surprised too. I was like, I couldn't believe that my research had worked so well. Now, I wish I could tell you though that every single one of my investment properties worked out that well. No, it didn't. I've had my fair share of hard knocks, and I've learned through experience that there are certain criteria. There's actually a property investing system, a research system you can use to analyze which markets are most likely to grow in value, because there's no crystal ball, there's no guarantee, right? But you can certainly stack the odds in your favor, and that's what this video is all about. In fact, once I have created this system and I fine-tuned it, not only has it worked for me, but I've helped many other people create wealth through property. For example, this couple came to me in about 2010 or so. At the time, nobody was talking about a price boom in Sydney or Melbourne, nothing of that nature. All they had at the time was their home. There was still some debt on the home, but they'd also had some equity. They were in their mid-40s and they were looking to sort of create wealth over the next 10 years, but had no idea how to do it, and they were busy at work. Both were in quite intensive jobs and long hours, so they didn't have the time or the resources to do all their research. We sat down together and put together a plan, and then I helped them find the right properties, secure the finance, help them get the properties all managed, and in a period of 6 years, they ended up buying 5 investment properties. They've now paid off the mortgage on their home. The rents are now covering the mortgages on the investment properties, which means the portfolio is now positively cash flowed, which means actually giving them an income every month. And they're now in a position where they can choose to retire far earlier than they ever thought possible. So, and that's just one example. I've used this system with so many clients over the last several years. So what I want to show you right now is the 7 things I consider when looking to choose which markets to invest in and why I believe those markets have great potential for growth. Because ultimately, you're looking to buy an investment property that makes you money. I know that sounds really, really basic, but hear me out. Many of us want to sort of buy property because either our accountant says we need to save tax, okay, or we see everyone else jumping into the market, we don't want to miss out, and all those things are fair enough, but the ultimate goal of buying investment property is to buy it for this and have it be worth more at some point in the future, and to stack the odds in your favor of that happening. So let's get into the 7 things that I look at when considering whether a market is worthwhile investing in, and what I believe the markets are that are going to have maximum chance for growth over the coming few years. So number 1 is current market direction. Now, I know that sounds really, really strange, but a lot of people don't consider what the market is doing at the moment. And really, there's only 3 things a market can do. It can be going up, it can be going sideways, or it can be going down, right? Pretty simple. Three things. Now, here's the thing. If the market's going down, why are you investing in a market that's dropping in value? Right? I mean, how do you buy something at a certain price, and if it drops in value, how are you going to make money? Okay? And that's exactly where we find ourselves with the Sydney and Melbourne markets right now. Don't get me wrong, they will rise in the future. But what's probably going to happen in both Sydney and Melbourne, just like what happened from 2003 in Sydney, is you're going to see a small drop, and then a long period of next to no growth. And from today to when prices start to rise, well, if last time was any indication, it could be 9 years. Right? I mean, that's what it was last time. And remember, this boom has been greater than any other boom we've had in history. So you've got to ask yourself, all right, yes, the Sydney market's going to do okay in the end. No, it's not going to crash. No, the Melbourne market's not going to crash. But if buying a property now in Sydney, is that what's right for you to invest in? And is that right for your investing goals? You see, because if you want to sort of retire next 10 years, you don't have this period of time down here to wait for the market to recover. So then we look at, okay, what about if a market's flat? All right, and there are a lot of markets that have been flat for a number of years while the Sydney and Melbourne booms have been rocketing along, or Sydney and Melbourne market rather have been rocketing along. Well, then the question is, okay, if the market is flat, what are the chances of the prices will rise in the future? You see, it doesn't almost matter what's happened in the past. What you want to know is what's going to happen in the future. So you want to see if the market's going flat, been flat for a long time, okay, now it's worth looking at. The third thing to look at is the market rising? Awesome. If the market was rising from 2012 in Sydney and a bit later on in Melbourne, you can make some serious money just by identifying markets that are rising in value and letting the market do all the work. I mean, there are plenty of people who bought property in 2012, 2013, who by 2016 had made $150,000, $200,000, many cases even more. All right? So you can definitely do that. However, the next thing though is if the market is rising in value, how long will that continue for? Okay, so I came out in 2016 and said, look, the Sydney property prices are overvalued. They just had 2 rate drops at the time, and prices had decided to kick off again as people took advantage of the cheaper mortgages. And I said, look, we're in a position right now where people can't afford those properties, which I'll get to in a moment, and prices will start to turn. Now, I copped a lot of flack for that online. However, CoreLogic today reports that our median prices in the middle of 2018 are the same as they were back in late 2016, and prices still can expect to fall, which means that if anybody who's bought property from about Christmas in 2016, today their property's worth less than they paid for it. And people who've bought sort of maybe in early 2017 who thought, oh great, price still rising, have actually seen the prices rise and then fall, and all that gain wiped out, and their price probably now is worth less than they paid for it. All right, so the second criteria, therefore, and I hope you can see where I'm alluding to, is this one. It is what I call local affordability, or affordability by locals. See, because what you need to consider when you're buying in a rising market like this is, are prices affordable for the locals? Because if they're not, if locals are struggling with affordability, you're going to see a lot of factors come into play to fix the affordability problem. So when our recent Premier took office in Sydney, her major thing was, I want to address housing affordability. Now, she didn't actually know how she was going to do that, but that was her major promise. Okay, we had APRA looking to clamp down on lending regulations. We had people looking to decrease the amount of foreign investment into our local property, because that was often one of the big reasons for these prices to keep rising, is people from overseas and investors were buying. All right, so you've got to consider whether locals can buy in the market. So right now, for example, the Hobart market, it's been the best performing market in Australia in 2017, bar none. All right, but at their next state election, both parties are literally taking to the electorate, to the people, policies on how to make property more affordable. Now, when that's the mandate, is that a market you should be investing in? When they in Hobart, because based on their income, right, their price point, although low for us in Sydney, low for us in Melbourne, it's not low for the average person living down in Tasmania. So you've got to consider if that's the right market for you to invest in. Because you never ever want to invest in a market that's being propped up by investors, interstate investors. Because when the market changes, and invariably it always does, things go backwards. We've seen that right now in Sydney and Melbourne, when they have essentially slowed down and made it tougher for investors to get into the market, and especially foreign investors. We saw this in the mining boom, right? When all of a sudden the market fell and investors cut and ran, or they couldn't even get their properties rented. So it's happened before, it's going to happen again. So always make sure that when you're looking to in a market, consider what is the affordability like, right? So for example, right now, the Brisbane median income is the second highest in the country to Sydney. In fact, it's actually higher than Melbourne. But yet Melbourne property prices are about 70% higher than Brisbane property prices. Doesn't make sense, does it? Right? How can a particular market have a 70% higher property price but have a lower median income? It's going to cause affordability issues, right? And that's what we're seeing right now. Okay, in Hobart, for example, the median rent, according to domain.com.au, is only $10 lower than the median rate rent in Melbourne, but the local income is far lower than Melbourne's. So you've got to look at the incomes and the affordability, because only if people can afford higher prices is there a chance that prices can rise. Now that sounds really, really basic, but we can fail to consider this when we're looking at investment properties, right? Because most of us look at the market, oh, I've got to get in, I don't want to miss out. But we forget the fundamentals. And over the long term, it's the fundamentals that are going to help you identify markets with great potential for capital growth and achieve your financial goals that you're looking for. So definitely look to see what is the affordability by locals in the market that you're looking to invest in. Because again, as I said before, only if the locals can afford prices to rise will prices have a chance of rising long term. Hope that makes sense. All right, so then we move on to number 3. And number 3 is population growth. All right, now, a lot of people at the moment will tell you that the Sydney and Melbourne prices are going to keep growing, going to keep booming because the population is increasing. Well, that's only partially true. Okay? Yes, Sydney and Melbourne still gets the lion's share of our migration, no doubt about that whatsoever. However, Sydney especially has actually started to lose people, more people domestically, which means although we get more people from overseas, when we look at domestic migration, we're actually losing people moving out of Sydney. So we're not actually having the net population growth that people are talking about. Yet, we still have so many more of these apartments. I mean, if you live in Sydney Driver, and there's still lots of cranes and lots of apartment blocks being built up and coming online and getting ready for completion. And so we're going to have a problem when all of these projects come online because the population, net population, is not growing as fast as people think. Yes, the oversupply will be absorbed over the next few years, but I'll come back to in a moment what that actually means. So you've got to start looking at net population growth. And for a long time, or for the last couple of years anyway, the Melbourne population has been the fastest growing market in the country from a perspective of population. However, as of our Christmas last year, CoreLogic reports that Melbourne got knocked off their perch. In fact, the city that right now has the fastest growing population is the Brisbane market. Okay, so if you look at the Brisbane market, the current market direction, it's been flat for a long, long time. We're now starting to see some prices start to rise. The local affordability is really, really good because prices are, as I said, have been flat for a long time. The median price point is still 70% lower than Melbourne, 80% lower than Sydney. Okay, but their incomes, well, said Brisbane's got the second highest income in the country. It's higher than Melbourne, and it's only 14% lower than Sydney's median income. So let me repeat that. Sydney property prices are about 80% higher than Brisbane's, but Sydney's median income is only about 14% higher than Brisbane's. That's why we're seeing a lot of people from Sydney move to Brisbane because their actually net wealth increases because the property prices are so much lower up there. And that's what's driving prices up. And that's why we've got this massive population growth happening. Okay, so 1, 2, 3, three of the major factors that I would look at. Now, I have no emotion when I look at these things. I'm purely trying to look at the facts and the data. I mean, yes, I have property in Sydney, and no, I don't believe the market is going to crash, but I also understand I'm not going to make a lot of equity gain in those properties for the next few years, right? I've held them for long enough, I've made some great gains, the rents have increased, so I'm happy. But I'm now looking forward, say, is that the market to be investing in to get growth over the next, say, 5 years, 7 years? It's highly unlikely at this stage. All right, so we've covered the first three criteria, and then we go to number 4, which is infrastructure and jobs. See, because again, if you're looking at population to grow, you've got to understand that populations will only grow. People will only keep moving into an area if they can get work there, okay? And so when you look at which state or which capital city has the highest dollar value of infrastructure projects right now, many people think it's Sydney, many people think it's Melbourne. No, it's actually Brisbane, the Southeast Queensland market, which has $134 billion worth of infrastructure projects right now. In fact, Deloitte Access Economics has predicted in January 2018 that the Brisbane and Queensland economy, rather, will be the strongest performing economy over the next 4 years, outperforming Sydney and Melbourne's. Why? Because of the investment up there in jobs and everything else, and the people moving up there. So you've got a lot to look at with the Brisbane market. So Hobart market, although it's been the best performing market and rental yields are really, really low, which is great, you've got to ask yourself, how much infrastructure is going there? How many new jobs are happening up there? And really, I mean, you know, Hobart is as nice as it is, no offense to anyone, I don't know anybody gets really excited about going to Hobart. But Brisbane, we all know, is a beautiful area and a lot of people are moving up there. So it's certainly worth checking it out, okay? So when you're looking at these criteria, it almost becomes very, very easy, and you have to be very unemotional about your investing, because I see so many people get so emotional. In fact, I get a lot of flack online and a lot of heated comments, people saying, oh no, but it's not going to be this way. And I'm like, look, I'm not necessarily saying that one market is better than another purely because I like it. I'm just looking at the data. I'm just looking at the research. And that's what you need to do. If you want to succeed from an investment perspective, you need to just look at the data and take the emotion out of it, and that's the way you're going to then create success going forwards, okay? So, infrastructure and jobs. Then we come to criteria number 5, and it's the dwelling type. So once you've identified the first four, looked at the first 4 criteria and identified a macro market, so whether it's whether you're looking at Brisbane or whether you're looking at Adelaide or wherever you're looking at right now, you then need to look at the dwelling type. So what are you actually going to be investing in? And this is again where a lot of media reports can be misleading, right? Because they will talk about a city and a city market, right? Like in Sydney, for example, they talk about prices dropping. But what they don't report until you look further into the detail is it is the apartments that are bringing the median price down. Not so much the houses, but the rental yields on houses is really terrible, okay? And in Brisbane, for example, that inner city ring, those brand new off the plan units that people sell with those beautiful glossy brochures and whatever else, could be the worst thing you could possibly do, because the Brisbane unit market is without doubt pretty much the worst performing market in the country, buying a unit there, okay? And because why Queenslanders still aren't like people in Sydney and Melbourne. They don't like to live on top of each other. They don't want to necessarily have to live close in and not used to high density living. They want some space. So you need to understand what that particular market wants. So when you're looking at the particular dwelling, you're looking for an apartment, a townhouse, a house, a big block of land versus a smaller block of land, you've got to make sure you do your research and find the right type of property for that particular market. And if you think this doesn't matter, let me give you a quick story. A client of mine bought a particular property on the upper North Shore of Sydney during the boom period. Prices were rising and it was great, but he couldn't get his property rented for several months. I couldn't understand it initially. I mean, I knew the area he'd bought in, it had overall a tight vacancy rate, so I dug deeper, and so what did he buy? He'd bought a 2-bedroom penthouse apartment in a suburb where the majority of people had large homes. So there wasn't a demand to get that property rented. So although he had some great capital growth, sure, he couldn't get it rented, which means his cash flow position was shot. He was struggling to pay his own home mortgage. It was a real struggle. And even when he could get rented, the rents weren't, at least when he's short term, and he's just has literally spoken to him recently, and he's had his tenant leave and he can't get a new tenant in place. Okay, so you've got to make sure that no matter what market you're buying in, you're buying the right type of property for that market, not necessarily what you would like to live in, all right? You've got to make sure you get that right. Then we go to number 6, and this is the vacancy rate. Okay, so CoreLogic right now, again, I keep referring to CoreLogic because they are without doubt one of the top research houses in the country. And they have come out and talked about how the Sydney property market has a record number of vacant property. In fact, the highest number of vacant properties they have ever in the last 13 years. Okay, the vacancy factor is rising the fastest compared to almost any city except for maybe Perth. Okay, and it's only expected to get worse. So when you look at vacancy rates, one of the things you want to look at is to ensure the vacancy rate sits at about 3% or lower. If it's lower than 3%, that means there are more tenants looking for properties than available houses. That's good. That's where you want to be investing in. But if you get a vacancy rate over 3%, then you're into oversupply, which means you're having more properties available for rent than tenants. And that's not what you want. And the median rent, or the average rent across all the Sydney is already sitting at 3%, just a bit above 3%, expect to keep rising. But that's the average rent. There are certain suburbs, for example, like Kellyville in the northwest, that has a vacancy rate sitting at currently about 7%. All right, it's terrible. And there are plenty of other suburbs out there with vacancy rates like that. So you wouldn't want to be investing in those areas, because how are you going to get it rented? Or you're going to have to drop your rent, or you're going to have to offer incentives like 2 weeks free rent or $1,000 towards moving costs or whatever. That's going to kill your investment. Okay, and certainly make it unpleasant at the very least. So always consider the vacancy rate. So there's the 6th criteria. Now, the 7th criteria has nothing to do with the market. It's all about you. And what I mean by that is this. What is your strategy? Are you looking to buy older property and renovate? Are you looking to subdivide? Or are you more of a passive investor, say someone like myself? And how I help clients is identify growing markets and simply buy new property or near new property and let the market do all the work for you so you don't have any issues with maintenance because maybe you're time poor and busy. So if that's you, you look for maybe the newer property. If no, you have time on your hands and you're okay getting your hands dirty, then you may look at the older property. But you need to consider your personality, your situation, your preferences. Never ignore your preferences when you're looking to find property in growing markets. So I really hope that helps show you how I analyze markets, what I'm looking for to identify markets with great growth potential, but also how I avoid markets that I believe are either running out of steam or not expected to have a lot of growth. Because if you get that first investment property wrong or your next investment property wrong, especially in today's scenario with APRA clamping down on lending regulations and really trying to, I believe in many ways, unfairly target investors, you get that first property wrong, it can completely put a handbrake and bring a crash to your investing goals. So take your time, do this research. As you can see, this research has nothing to do with going on realestate.com.au or domain.com.au, any other property site, and looking at the cheapest properties or everything else, right? That all comes towards the end. You've got to start doing this research first. You need to, and a lot of this data can be available off the Australian Bureau of Statistics website. That's where I get a lot of my data from. So check out the data, invest according to facts, data without emotion. And if you don't have the experience and the time, or you don't feel comfortable doing it yourself, make sure you speak to someone who does have the expertise, who's got the years of investing experience behind them, done it for themselves or done it for others, to be able to help you, all right? Because then you are going to maximize the chances of creating wealth. And when so many other people are saying you can't create money through property from 2018 and right now, you can simply be the smarter investor, the more strategic investor, the person who got the right help, got the right guidance, found the right opportunities, and in a few years' time, people will be asking you, how did you create money in property when you started investing in 2018? I really hope this video helps. Let me know what your thoughts are below, and if you want further videos like this, only ask one thing. I'm not going to ask you to give me your email address so like others do, they bombard you with emails. I'm not going to say come along to a free seminar, which I'm not going to insult your intelligence. If you go to a free seminar, they're going to sell you something somewhere down the track. All I'm going to say is just like this video, share it with a friend if you think it's valuable, and also make sure you like my page, the Investment Rise Facebook page. That's where we put our latest content like this, and I really hope then that I can help you understand and navigate the sort of confusing times that we're in right now. Confusing times are often the greatest times for opportunity for the strategic investor, because you find opportunities when everybody else is not looking. Everybody else is asleep at the wheel. You're still out there looking for opportunities, getting the right help. And as I said, you could be the person who in a few years' time, people look around and say, how did you do it? How did you make money in property when the Sydney and Melbourne markets were falling? I really hope this video helps. Let me know your thoughts in the comments field below. Bye for now.